We've seen some big gains on the S&P 500 in a very short period of time, and this is happening with the stock market at an all-time high. You can often see strong returns during market recoveries after significant bottoms, but it's less common to see the market move up this rapidly at all-time highs. Here, we've seen the S&P 500 return more than 5% in just 4 trading sessions in November. The last time we saw this was in November of 2023, and before that, in October of 2022, marking significant turning points in the stock market. Today, we're seeing the same strength, but with the S&P 500 at new all-time highs. It's also very interesting to see that the S&P broke out above a consolidation range between July all the way until October. Especially during a presidential year, you can often see volatility heading into the presidential elections. That's what happened this year. When we add the VIX, the volatility index of the S&P 500, on top, we see that it did spike heading into this seasonally volatile period. And now, following the election, the market is melting up and volatility is coming down. If we zoom in closer to look at the price action of the S&P 500, this is a big channel that a lot of investors are looking at. There are always different ways to look at technical analysis, and everybody has their own approach to observing and making sense of market price action. That's the important thing to understand about technical analysis. There's not one rule that fits all. The most important aspect is to gain an edge and understand the price action to get a good sense of the probability of something happening in the future. That's essentially what trading is all about. Here, we have lots of key reactions on these trend lines, with the top of the range marking these reactions. This line of resistance is very important, but also this middle line right here, with lots of key reactions, here and here. And then again, more recently, resistance right there, big line of resistance. And then some levels of support right here. If we zoom in a little bit closer, we see the S&P 500 is now at channel support. This is a critical level that could determine the next significant move. If the price fails to hold this support level, it could perhaps trigger a move down to the lower channel support, and a break below that could be a sign of deeper correction towards the next support near 5,800 points. On the other hand, if price holds this support, it is possible that we see a test of the upper resistance. And a decisive break above this resistance could even potentially open the path to the channel top near 6,500 points. However, it's important to note that price channels can contain the price action for extended periods. It could also be that the S&P 500 index simply continues to trade within this tight middle range like it did for the better part of October. However, some indicators are suggesting that that may not be the case for very long. For example, the MOVE index has been declining recently. This is the bond market volatility index, very similar to the VIX index we looked at previously, but for bonds. When we flip it around and add the S&P 500 on top, we see that the two are very closely correlated to one another. There was a concerning signal heading into the election, as we saw the bond market volatility rising while the S&P 500 was climbing, what we call a divergence. This pattern was particularly important because we saw something very similar happen in late 2021. At that time, rising bond market volatility, while stocks made new all-time highs, served as a warning signal that ultimately led to a 25% decline in stocks. For stocks to perform well historically, the bond market typically needs to be stable. Stocks tend to perform better during periods of stable interest rates, as this allows investors to have more confidence about the way that they're allocating capital. This explains the historical relationship between the stock and bond markets. Currently, the MOVE index is declining, which some interpret as a bullish signal. The key question now is whether this stability in the bond market will continue. A further stabilization in the MOVE index could be a fuel for the rally on the S&P 500 to actually continue higher against all odds. The OEX open interest ratio provides another interesting perspective on the market. It typically spikes when the market is making a big peak. For example, in early 2020, the OEX open interest ratio was spiking as the market was nearing a big top. In late 2021, there was also big spikes in the OEX open interest ratio. They were also correctly positioned in August 2022. As the market moved higher, the OEX open interest ratio spiked, marking the exact peak before a 10 to 15% decline. However, it's important to understand that no indicator is perfect. There are many examples of signals that didn't lead to the expected outcome. January 2024's spike, for instance, didn't result in any meaningful correction. But today, we're seeing historically low readings in the OEX open interest ratio despite the market being at all-time highs. These low ratios have historically been associated with periods that have been constructive for stocks throughout the last 10 to 15 years. Here, October 2022 marked a short-term bottom. Here, January 2021 marked a short-term bottom. In December 2018, it marked a short-term bottom. Here, December 2016 also was followed by additional upside in stocks. In 2020, a low open interest ratio occurred at the very bottom of the bear market during COVID. So this is one of the indicators that's important to keep an eye on because it potentially provides a little bit of an edge on the market. It doesn't have a perfect track record by any means. You can see in late June and early July, the OEX open interest ratio was quite low as the market was actually making a short-term peak. So that was a false positive signal. The current low reading might seem surprising given that the market is at an all-time high. It could reflect either institutional complacency or genuine conviction in market fundamentals. Time will tell. So is there anything that can kill this massive bull market? One big risk to the market is oil. Energy costs can affect both corporate profits and consumer spending. Currently, oil prices remain relatively stable, but history shows this can change rapidly due to geopolitical events, supply dynamics, or shifts in global demand. Another potential risk to stocks is the job market's health. Initial jobless claims serve as a leading indicator of employment trends. For example, if initial jobless claims in the US start trending significantly higher, that could be a sign the job market is weakening and would potentially be concerning for stocks. Today, we see initial jobless claims have actually been moving lower over the last few weeks. Of course, this could all change very quickly. These factors don't predict immediate moves, but rather provide a framework for understanding potential market shifts. Markets often maintain trends longer than expected, but they can also reverse quickly when conditions change. We'll continue keeping you informed on key economic and market trends every step of the way. You can trade the S&P 500 index with the ticker US 500 on the Capital.com platform. Thank you for watching.